Hi, good evening, everyone. We will start in just a couple of minutes. Thank you for joining on time. Just give us maybe 2 minutes or so. Thank you. So, thank you, everyone, for joining. I think it's time, and I think we should start off. Today we are going to discuss about these three different kind of funds which have gained a lot of popularity in last 1.5 year or so. The idea here is that we'll be discussing about index funds, we'll be discussing about international funds, and then a bit of sectoral funds. So these three funds predominantly are looked upon as an additional investments towards your equity portfolio. So once you try to construct your portfolio in mutual fund, your core portfolio ideally should be in equity diversified funds, and then these funds can chip in from an additional investment perspective. So we'll go through these funds, these kind of funds one by one. Okay. Let us start with the index funds. Let us start with the index funds and who should consider investing into a index funds. So before we get into who should start investing into index fund or who should have an allocation towards index fund, let us quickly look at what are index funds. So index funds are basically passively managed funds where there is no role of a fund manager. So the fund manager will not have any role when you look at index funds. These investments are based on market capitalization. So bigger the size of the company, okay, the possibility of that company coming into the index is higher, and likewise the possibility of those companies coming in the form of portfolio of the index fund is higher. So when you look at index funds, these are predominantly driven by market capitalization, and there is no other criteria. What are passive funds and what are active funds, we will discuss subsequently. Coming to the next point is the weightage of the portfolio will be the same as per the index. So if we say that Nifty 50, which is basically the top 50 companies which are listed on NSE on the basis of market capitalization, okay, have a weight of, let's say, 10% in HDFC Bank. Similarly, in a index fund, in the index fund, the fund manager or the fund will have HDFC Bank at 10%. So that is how index funds are predominantly driven only by market capitalization. The portfolio will be realigned as and when there are changes in the index. So let's say the index changes and there is a new stock which comes in. So as soon as the new stock comes into the index, similarly, the fund manager of the index fund will tweak the portfolio to match or mimic the index. So it is completely aligned to the underlying index. Since there is no role of a fund manager and there is no need for any research team, the expense ratio of these funds are very low when you compare it with actively managed funds. And of course, these funds are quite popular when you look at developed countries where the markets are at a matured stage. So what happens there is, since the markets are at a mature stage, the skill set of the fund manager to identify an upcoming company which will do better than these established companies, okay, they need much more time and much more efforts to find those kind of companies. So what we have seen is a transition where most likely the active funds which are doing well, which may continue to do well, along with, of course, the index as a part of an allocation over a longer period of time. And then as and when we become more matured as the community which invests into stock markets, the preference will gradually move towards the index or the index funds. That is the reason the index funds are more preferred in the developed countries. So let's understand the difference between the active fund and passive funds. Okay, so these are two terminologies which are used to understand how the funds are managed. Now, active funds is where there is a role of a fund manager in deciding what stocks will come into the portfolio. When should the portfolio be trimmed, okay, or should it move into cash? Should we book the profits? All these calls are taken by fund management team and the research team when it comes to actively managed fund or active funds. In passive funds, there is no role of a fund manager, as we discussed. It will purely be based on market capitalization. So that brings us to the next point where these are the criteria which will be always there in the mind of the active fund manager, like market capitalization, market conditions, how does the interest rate scenario looks like, a lot many other criteria pertaining to the investment. Where in passive funds there is nothing to be discussed about or worried about. It's purely been on market capitalization. The pool of companies is huge when it comes to active funds, because the active fund manager can actually the universe for the active fund manager is much more bigger, because they can simply invest across market capitalization, bigger companies, smaller companies, if they feel that there is a opportunity in those kind of companies. When it comes to passive funds, most of the passive funds are focused on either Nifty 50 or Sensex. Okay, and then of course there's next Nifty 50 and all those other funds are already there. So, but predominantly they'll be focusing more on the top 50 or top 100. That's how the index have been worked upon. Now, coming to the next point, the possibility of churning. So, what happens in an active fund, since the fund manager is closely looking into different situations and scenarios, there is a possibility that the fund manager will keep on buying and selling the stocks on the basis of the thought process or the process of the fund, which is quite unlikely in a passively managed fund, which is like your index fund, where the portfolio will only change if in case there is a change in the in the index. So if a new stock comes in, then there is a change. Okay, so the new stock will come in and the old stock will go out. So that's where the churn will happen in the index fund, only in case there is a change in the index. And of course, just because there are fund managers and the research team, and then these are actively managed funds, the cost on active funds is higher compared to passive funds. That's another reason why a lot of people started preferring passively managed index funds, because the cost compared to the actively managed funds are much more lower. So before we get into more about index funds, let's just have a quick look at what kind of index or market capitalization we are talking about, because index funds are predominantly based on market capitalization. So if you look at the companies which are listed in India, the large caps are predominantly the top 100 companies. Then comes the mid cap, which are the next 150 company. So the pool for a large and a mid cap in a way is around 250 companies. For a large cap company, it is around 100. For a large cap fund, it is around 100. At the same time, for index, let's say Nifty 50, it will be the top 50, or for Sensex, it will be top 30. And then there's a pool of small caps, which are remaining companies which are listed on the market, where the number goes up to 5,000. So overall, 5,000 companies listed. What happens in an active fund manager or an active fund is the fund manager has all these companies to access as a universe, whereas the index fund manager will have to focus only on the top 30, top 50, or maybe the next 50 companies. So should we actually look at index funds? Before we get into that kind of a conversation, let us try to understand what index funds have been doing across these years for its investors. Now, just to explain this particular table, what we have done is we have pulled out SIP returns for 1 year, 3 year, 5 years, 7 years, and the same for the same period we have pulled out lump sum return. Now, the idea here is to put forward how index funds have behaved across different market conditions, across different years. At the same time, if the investments have happened in different manner, either SIP or lump sum. The way to read this particular table is the row that we have. Okay, let's say if in case we consider 7 years SIP. Okay, the greener the cell, okay, is the higher the returns. Okay, more reddish the cell, lower the returns. The orange are basically, they are right in the middle, okay, trying to balance it out. Now, if you see the entire table, and the table has been purposely split into 3 parts, these are the funds which are your index funds. So these are the 2 index funds that we have considered. These are the 3 funds: ICICI Prudential Blue Chip, HDFC Top 100, and Aditya Birla Frontline Equity. These 3 funds were almost 3-4 years back, like top of the table, and everyone would wanted to invest into these funds. And these are the funds where people are showing the preference to invest right now. The idea here is to see what were the top funds earlier. That time index was there. What are the top funds today? Today index is there. Okay, and does index give us a case of investing into that particular fund? Okay. So now if you see here, across all the tables, we can see that index most of the time continues to be on the midway or very close to the funds which have done well. Okay. So this helps us to tell us that index fund does have a case when it comes to investing into our portfolio, and we can certainly look at index funds as a part of the allocation. If you pull out any period, let's say around 5 years investment of SIP, the index funds have given close to around 16.7, 16.6. Okay. Wherein the funds which were on the top almost 3-4 years back, okay, have underperformed the index. The funds which are right now doing well have done better. Of course, there's an important thing, that is that in last 1 year, these funds have done well, and that is helping them to perform or show that returns, because that returns of 1 year is also trickling down on 3 to 5 years and 7 years. Another important thing is, you can also understand from here is the sort of returns that one can expect when you invest either in lump sum or SIP. While that concept is different, and we will take it up some other day, the idea here is to put forward that if anyone goes for an SIP or an index, most of the time SIP or lump sum, index fund do continue to have a proper case where we can certainly consider investing into index funds. Now, so who should invest into uh, index funds? Now, so who should invest into index fund? So what happens is index funds should ideally be are like investments are happening in giant and large cap companies. Hence, the risk on these funds are very limited. Okay. Uh, yeah. Okay. So, just one request. Uh, Please send your queries on the chat section. Okay, that will be very helpful, and we'll take up those questions at the end of the session. Yeah. Thank you. Thank you. So, why should you consider index funds? So when you look at index funds will be predominantly investing only in your giant caps and large cap companies. Hence, the risk on these index funds is very limited. Since they are investing into big companies, the volatility is less compared to an active fund, where that when the pool of companies for active funds is much more bigger, okay, so they can tend to invest into a small cap or a large cap, a small cap or a mid cap, which will add the volatility. Okay. Hence, in index funds, the volatility would be much lesser compared to the active funds. There are no human bias while constructing the portfolio. Like, we all are humans, and we may all have, despite of understanding each and every aspect of business, we may still continue to have some aspect of biasness. What happens in an index fund is there is no such issue about biasness. It's purely driven by market capitalization. Hence, that human barrier is removed when you look at index. And as we discussed, the expense ratios, the cost that you pay to manage that fund is lower, which is compared to the other active funds. Hence, it will end up having more results in your returns for you. So, what happens in a index fund is predominantly, it's purely based on market capitalization. Now, there's a risk that is involved here. Okay. Now, what's going to happen is, since it's only market capitalization, the fund has to remain invested into a stock, despite of that could be a right or a wrong time for the fund to be in that particular stock. Okay. So that becomes a sort of a limitation or a risk when it comes to investing into the index funds. Okay. Now, similarly, there have been occasions in past where there are companies which has been part of index for a quite some time. Okay, and then these companies continued to be in index when they were going through crisis. But the fact that these companies are part of index during their crisis, the fund have to hold it. Okay. So classic case of Yes Bank. So Yes Bank had a lot of issues, and a lot of active fund managers would have exited Yes Bank long back. But unfortunately, since Yes Bank was a part of index for a long time, okay, till the time it went out of the index fund didn't had a choice. They had to hold on with Yes Bank till the time it is out of the index. Now, this is one of the biggest risks in our view when it comes to investing in index funds. And then, of course, it has exposure towards your large and giant caps, which is in a way a sort of an advantage. But for investors who would like to invest into mid or a small cap, they miss out on the opportunity because it has no exposure towards mid or a small cap from that perspective. So who can look at investing into an index fund? In our view, all investors can actually look at having an allocation in index fund. When it comes to investors who are at the beginning stage, or those investors who want to take limited risk, they can have more allocation in index. So in our view, those investors who are at the beginning stage, okay, can look at around 20 to 25% of allocation in index funds, okay, and then as and when they get more experience, of course, when they move from a beginner or a risk averse investors into moderate to high risk profile kind of investors, then that allocation can come down. For an investor who is at moderate risk profile or a high risk profile, can also look at having close to around uh, 10 to 15% of allocation in index funds. Uh, there are a lot of people who are retired and they continue to hold their investments into equities. So in such a case, it is better that these retired people can also park some part of their money in index funds, because the risk on that equity exposure through index is much lesser compared to an active fund, which may also invest into mid and small cap. So in our view, index fund works for everyone, and it can be a part of your allocation. So one of the reason why we are saying that it can be a part, despite of having the pros and cons that we discussed, is one is it does gives us an opportunity to remain invested in large cap, okay, which over the period of time can perform well. But at the same time, okay, we are restricting the allocation or suggesting that maybe around 10, 15 or 20% of allocation, and the rest can be into actively managed funds. Because when you look at India today, there is a much more possibility of fund manager being able to identify companies which can do better than the benchmark, okay, where there are a lot of potential which is still there in multiple sectors and multiple companies. So that can be explored by your active fund manager. At the same time, this passively managed fund focuses on big companies based on market capitalization, where the volatility is less. So this does bring some sort of a volatility, some sort of a stability in your portfolio. So coming to international funds. So, of course, we are going to discuss about what are index funds, and what are international funds. All these things we'll discuss. Let's go one step ahead and see what are international funds. So, what are international funds? Basically, international funds are investing into companies or entities listed outside India. Now, here you get an opportunity to invest into some of the biggest names in the world, where which are one is not listed into India, and as an Indian investor, there are a lot of restrictions and difficulties of directly investing into these stocks. So what happens in international funds is it also helps us to invest into different geographies. So international funds are typically based on geography. Like most of the international funds in India are on are based on US, and there are some international funds where the investments is happening into Europe and even in Asia. But predominantly in India, the international funds are more focused on US. Uh, Most of these funds are funds of funds. So basically, these funds have tied up with a fund manager based in US or Hong Kong, okay, or Europe, and they are managing the fund, and this more becomes as a feeder fund, okay, for those funds. So these funds are like funds of funds, where the investments are getting pushed from our end, the money gets pushed to the international fund manager, and the investments happens in USD. So these are some of the names. We are users of some of these products, but we are not the investors. So what happens in an international fund is, it does give us an opportunity to invest into some of the big names across the world. Okay. It could be Apple, Alphabet, it could be McDonald's, could be Netflix. Okay, it could be TSMC, which is the biggest semiconductor manufacturing company. Okay, Baidu, which is like Google of China. Okay, so these are the companies where you get an opportunity to invest into, if in case we invest through an international fund. So it does give us an exposure to a domain where probably we do not have the best possible reach. But does it work for us? And should we go for it? Let's discuss it further. So one of the reasons which creates a case for international funds to be a part of our portfolio is, okay, there's a less correlation between our stock market and the international stock markets. Now, just to explain that correlation part, okay, the thought process here is that whenever Indian stock markets goes through underperformance or trouble, if the other country's stock market goes through the same phase, then the correlation is higher. If the Indian stock markets are not performing well, okay, and international or the country in which you are investing is doing well at that time, then there is a lower correlation. So if we look at the international funds that are listed and how they have performed across these calendar years, and these are our Indian funds. So one thing which comes up is the years when India have performed or given lesser returns, international does give us higher return. Similarly, when you see that when international funds have given us lesser returns, India tend to do better. So this does create a case of having some allocation because of that lower correlation. And in a way, that's why we are saying that we are decoupled, separate. So it gives us an opportunity. It does give us an opportunity to park some money into international funds. But of course, each of these funds do carry its risk. Like, there could be currency risk, okay, and there could be risk of having more allocation into one particular sector. Of course, we are going to discuss in subsequent slides. But the point here is that, okay, if you look at India, okay, this is the returns every year someone would have invested into India would have got. Now, if there was some allocation into, let's say, international funds, then let's say when this year it was not performing, it was not performing well, or you had this investments into large cap and flexi cap, which was doing better. Okay, you would have underperformed. Your overall portfolio would have underperformed. Similarly, okay, if you see years where, like, last 2 years have been phenomenal, predominantly the international funds, as we discussed, are based on US and US markets. US markets have had a phenomenal run in last couple of years, okay, and that is quite evident from the returns that these international markets, international funds have given. But we have to keep in mind that each and every country, each and every market go through a cycle. And that is something that we always have to keep in our mind whenever we invest into international funds or even Indian stock market. So why should we consider investing into an international fund? So of course, it gives us geographical diversification. It helps us to invest across different companies across different countries. We did saw that there is a low or limited correlation. So it does help that if one geography doesn't work for us, there is some return which is being generated by the other geography. Of course, the opportunity does lies to invest into global leaders. We did saw some brands, and we can certainly invest into these brands when we invest through an international fund. And the portfolio, it gives us a diversification within the portfolio in sectors and strengths. So let's say there are countries like US are more focused on innovation. And then there are other regions where that are focused more on energy. Okay. Then there's China, which is more focused on manufacturing. Okay. So all these countries and the potential of investing into these countries can be taken care by investing into international funds. But yes, it does come with a risk. So the first risk in our view is, while we are investing through a fund of fund, we do have very limited knowledge about these companies. So there's at least when you invest into India, you are quite sure about what's happening within the country. What are these companies doing? There is very limited information that we may have when it comes to international stocks and their underlying companies. One of the biggest risks of investing into international funds is the currency or the exchange rate risk. Whenever the rupee will appreciate, the value of the portfolio will come down. Likewise, whenever the rupee will depreciate, the value of your portfolio will increase. Now, this is one of the biggest risks that one will carry whenever you invest into international funds. And of course, most of these funds are funds of funds. So there is a huge reliability or expectations from the international fund manager. So that's another risk on how they have been performing and what they have been doing is where we have another space where we have very limited information or knowledge. And since most of our international funds are focused on US and these are probably following NASDAQ 100, there's a possibility that there is an overexposure towards one sector like technology. So these are some of the risks that we have to keep in mind before we invest into international funds. So we did touch base about NASDAQ 100 and then the allocation into technology. There's another important point that not all international funds are same. We cannot look at just by the name that this comes under international fund category and they have been investing into just in US or any other country. So whenever you look at international funds, there are two things that we have to look at: is the countries or the list of countries where that international fund is investing, and second is the sectors. Within that, let's say both these are US based, but within that also there's a difference in sector. So your S&P 500 is more diversified, where the reliability on or the biggest sector is 27%. That's information technology. Same way, if in case we look at NASDAQ has almost 56% of exposure towards technology. This is one of the risks that we highlighted. At the same time, it's an important point for each one of us to consider while investing into the international fund. So it's very important to know which country the investments will be going and in what sectors these investments will be going. Are you overweight or underweight into any particular sector, and is it well diversified? So while international funds does give us an opportunity, in our view, the first focus should be on building India-based portfolio, at least for we all Indians who are investing into equities and trying to make a portfolio in equities. The reason we are saying this is the data from IMF, where there are 3 countries and their GDP growth which has been mentioned here. Okay. So the dark brown line is the India. Okay. Almost the golden or the orange line is China, and the blue line is US. This is up to 2020, this is 2021, and this is 2025. If you see, okay, subsequently in coming years, it is expected that India's GDP growth will be much more faster than rest of the world. And hence, we believe that we have a lot of opportunity in India itself. So the way you should go ahead and build your portfolio is your core portfolio should be based on India and India focused. Then over the period of time, when you want to diversify, you can go ahead and diversify into the international funds. So create your core portfolio should be India based. So who should invest in international funds? So investors who are already having well diversified investment in India. So jinka portfolio India based ban chuka hai, they can consider investing into the international funds. Like we said, first build your India portfolio and then get into it. Those investors who want to supplement their domestic fund ka investments, by adding some of these global leaders. Investors with moderate to high risk profile investors should ideally look at investors into or investing into international fund. Uh, Investors who are at the beginning stage should ideally avoid investing into these international funds. First, try to build, your India-based portfolio, that too predominantly with the help of large caps and index funds. And then once you gain some experience and your portfolio becomes much more stronger in India, then you try to diversify in your international funds. And of course, like it's always in equities, all the investors in international funds should have a long-term or holding period or horizon. So, in our view, the allocation towards international fund can be between 10 to 15%. That's how you'll have to restrict, or you may restrict your allocation towards it. Okay, because we still believe that your core portfolio should be India driven. While this does give us an opportunity to diversify. Coming to the third segment of the presentation, which is on sectoral funds and thematic funds. So before we understand about the sectoral funds, let us quickly look at the kind of sectors and the number of companies that exist in India. So there are companies across different sectors and industries, and there are these are the number of companies which are listed in the stock market. And these companies could fall either in large cap or mid cap, or it could be predominantly also in the small cap space. Hence, it's very important to look at sectoral funds very closely before you take a call or decide to invest into sectoral funds. So what are sectoral funds? These funds are going to invest into companies and industries which are based on particular theme or sector. Now, at any point of time, there would be different themes that will be doing well based on what is the environment. So like, most of us would have seen that during pandemic and like in last 1.5 year, the healthcare and pharma sector had given substantial return, and a lot of the attention of investors got diverted towards your pharma and healthcare funds. What happens at this stage is that it could be cyclical in nature. So that's another point that is very key about or important about sectoral funds. If you look at these themes, let's say a government policy which comes up, which focuses on that particular sector. Like few years back, when infrastructure was the focus of the government, a lot of infrastructure funds that have come in. So how they have performed vis-a-vis the big companies, we will see, and large caps, and even the large and mid caps, we will see that. But the point here is that these funds, that is your sectoral and thematic funds, will be predominantly investing into companies based on a particular theme. The most commonly known are, of course, banking, technology, consumption, infrastructure. These are the most commonly known sectoral funds. So we did touch base on that sectoral funds can be cyclical in nature. So if you look at the returns given by these sectoral funds compared to the diversified fund which invest across sectors. So your top 4 rows belongs to the funds which can invest across any sector, okay, and even market capitalization when it comes to the second to the 4th row. And then you have sectoral and thematic funds. The way to read this is almost the same. Okay, if you look at 2020, the red ones have been underperforming, the green ones are top performer, and the orange ones are like average performers. Now, if you see year on year, your top 4 rows continues to be in either green or orange. And if you see in the bottom, okay, after that, there are a lot of reds and greens. It tells us that if in case you invest into sectoral fund, at one stage it can be in green, it can be performing very well, then it can go through a a bad phase in the subsequent year, or maybe a couple of years later. So like let's say classic example of pharma, okay, with like 2020, where it has given around 66% return. But if we look at 2019, calendar year 2019, it has just given 3% vis-a-vis a large cap or a large and a mid cap or a flexi cap, which has given around somewhere between 8 to 11%. Then if you see another aspect is, after 2015, it is the first time in 2020 where pharma has been able to generate higher returns compared to the other funds. So keep in mind that sectoral funds can go through cycles, and there is a tendency for these funds to perform well at one particular time, okay, and then they may remain flattish or give negative returns for quite some time, and then they will then come back again to generate returns. So it's meant for investors who would like to take higher risk. So what are the risks for these funds? Okay, of course, we did saw that these funds are cyclical in nature and can go through different phases. The investment that happens in sectoral funds is limited to few companies. Now, while there could be 100, 200 companies within one sector, but it's not necessary that all 200 companies are worth of investing. Now, with this, what happens is, let's say if there is a fund which focuses either on banking, or let's say if there is a fund which focuses on consumption. So the number of companies are limited, and the portfolio need to be constructed based on these companies. So there is a possibility that that the best stock in that particular portfolio could be overweight when compared with any other diversified fund. And with that limited number of companies in the universe, the portfolio can also tend to be very concentrated. Now, like in index funds, where we discussed that the companies where the index funds are investing, okay, the index fund has to follow a mandate. Similarly, in these sectoral funds, the fund manager has to follow the mandate of continue to remain invested in that particular sector, even though the fund manager or the fund management team are very sure that this particular sector may underperform for a long time or for a shorter time. Now, that flexibility is available when it goes to the actively managed, your diversified funds, which can invest into any sector across any market capitalization, where in sectoral funds and thematic funds, this become a huge limitation. And of course, these funds can be highly volatile when compared to diversified funds. So who should invest into these sectoral funds? In our view, beginners, risk-averse investors, and even investors who are having moderate risk profile should ideally avoid investing into sectoral funds. It does carry a lot of risk. Hence, we are saying that investors with high risk profile can consider investing, but there too, okay, you need to limit your exposure towards that particular or sectoral funds to somewhere between 5 to 10%. And of course, investors who are belonging to that particular sector where they have complete information and knowledge, probably they may consider investing into sectoral funds. But as a thumb rule, I would put forward that avoid sectoral funds. You are better off with a diversified fund, because your diversified fund manager also have an opportunity to invest into a particular sector if that particular sector is expected to do well and perform well in future. Hence, try to avoid sectoral funds, and if in case your risk appetite is high, then only get into sectoral funds. So how do we build our equity portfolio? We know we know about equity diversified fund, which gives us a lot of opportunity to invest across large cap, large and mid cap, flexi cap. And then, there are international funds, and there are these index funds and these sectoral funds. So how do we ideally go ahead and construct our portfolio in equities through mutual funds? So in our view, the way you can look forward to construct the portfolio for long term is you can consider around 70 to 100%. And why we are saying 100% is for those investors who are at the beginning stage, or who do not want to take much risk. Then you are better off parking 70 to 100% of your overall portfolio in these 5 funds, okay, or a mix of these 5 funds, or not necessarily 5 funds. You can create a mix of these 3 funds as well. Okay. So predominantly focus on large cap, large and mid cap, flexi cap. Okay. These funds and you can certainly look at around 70 to 100% of your portfolio. If you have some additional capability to take some additional risk, okay, then you may like to add maybe around 10 to 15% in mid caps. Small caps are more for people who have much more higher risk taking ability. In our view, sectoral funds continues to be extremely high risk, but if someone wants to go for it, you have to limit that exposure, or you can limit that exposure to 5 to 10%. And then, of course, once your India portfolio is built properly and you are quite confident about your India portfolio, okay, that becomes your core or the anchor of your portfolio, your India portfolio, then you can try to diversify in international funds, where you can look at around 10 to 15% of your exposure towards that particular fund. Okay. So now, if you look at from a risk profile perspective, if in case you are a beginner, or if in case you are you're investing in for for a longer period, but at the same time you would like to take lesser risk, then it is better to be in funds which are marked in green. If you want to take some additional risk, then you probably get into green plus these this light red shade, okay. And of course you can add some element of orange in that, okay. And only if in case you would like to take much more higher risk, then you get into the sectoral funds. So I am done with the the presentation today. The idea was to explain each and every kind of the fund that was that people are looking out in today's time, where it has gained a lot of popularity, like particularly the index fund and the international fund. These 2 funds have gained a lot of popularity, and of course there's been a reason of the performance also. So if in case we look at index funds in last 1 or 2 years, the index funds have done much better than the actively managed fund. Okay. But what happened is that the fall of March 2020 did give a lot of opportunity to active funds to do well, and that's where you see that the active funds again started regaining the traction. Okay. While we do believe that there is a merit of investing into index fund, there is also some merit of investing into international fund after creating a solid India portfolio. Okay. However, sectoral funds, in the best possible view, okay, we will put forward that you can avoid it. But if in case you want to take that additional risk, then keep a very limited exposure towards the sectoral funds. With that, I will, we have some questions, and if in case you have any questions, you can push it on the chat section, and we will certainly take those questions. Okay. So the question is it correct that index funds are relatively safe? Okay. And that is, it cannot be better than index due to addition. Okay. So the question is that, is it correct that the index funds are more safer from a, from a long-term perspective, at the same time compared to the other diversified fund? So in our view, yes, it is. The only risk element which comes into index funds is, occasions like, Yes Bank. Satyam was in index on the day uh, the scam was disclosed. So there are few elements where diversified fund manager have a scope of studying the company and understanding the company in a better manner before parking the money. Okay, while market capitalization is one criteria, but there are other criteria. Hence we suggested to have close to around, let's say, 15 to 20 or 25% in index, and rest can be into equity diversified fund. Because as we go on becoming more matured, there is high possibility that we will be doing we will be also moving towards our inclination towards index, because index will become also more matured. Okay. Then I'm just reading few questions. If in case I get more, I will definitely tell you. Okay, so there's one question that I am doing an SIP in Parak Flexi Cap Fund and Access Growth Opportunities Fund. These funds have exposure of 25% of international equities. Should I go for Nasdaq 100 fund of fund? So I'll tell you, these, both these funds do have exposure towards international stocks. Okay. But if in case your portfolio is only in these two funds, okay, then you are already invested into international stocks. Then you may not need to add another international fund. So one of the best way to look at uh, the overall portfolio and where the money is invested is that always look at the underlying asset or the underlying companies of the overall portfolio that you hold. So I may hold 5 funds or I may hold 8 funds. All the 8 funds are investing into lot of companies. Now each of these companies will get classified as a large cap, small cap, mid cap, or international company. If you look at your portfolio from that perspective, it will give you a clear idea that how much of your overall money is invested into international. If in case you are already investing into these 2 funds, okay, then you, and of course, assuming that there are no other funds that you are being investing into, then their exposure is already 25%, and you need not add more in our view. So the next question is the thematic and sectoral funds are, if the thematic and sectoral funds are cyclical, okay, is it suggested for short-term investment? Okay. I'll tell you short term. So one is, of course, our thought process is that equities are for long term, not for short term. Okay. And then the more shorter the period for uh, any equity fund, the risk is higher. And if in case that investment is into a particular sector, okay, the risk gets added more. So hence, we would suggest that one is look at sectoral funds or thematic funds. One from a phase where you are already taken care of your overall portfolio. One, you have some additional money in your portfolio which you want to generate or use to generate additional return. That part of the portfolio probably you would like to park into thematic and sectoral funds, because at the end of the day they are also going to, in these funds are also going to invest into your um, equities, and that too some of these companies would be large cap, some of these companies would be mid or small also. So you have to give sufficient time for these funds like sectoral and thematic funds to perform. But the idea about showing that cyclical nature was to say that the risk on your sectoral is much more higher, because the investment is only happening in one kind of business or one kind of industry. Okay. How can we invest in international fund, and is tax applicable as per the country where we have invested? So no, these are fund of funds. So when you invest into international funds, and since they are funds of funds, the taxation is as per the debt implications. Okay, so it will be 3 years, up to 3 years, it will be short-term capital gains, and after 3 years, it will be long-term capital gain. All right. Any further questions? Okay, so we have a similar question on taxation on our on our YouTube channel, and I think we just answered that from a taxation perspective, the funds it's treated as fund of fund. Okay, and all fund of funds in India have a tax implication similar to debt. So up to 3 years it will be short-term capital gains, and uh, after 3 years it will be long-term capital gains. Okay, so I think we have done with the questions. I would like to thank everyone for joining. We will we look forward to catch up again with some more exciting topics, which will help us to decide how do we take care of our finance, at the same time how do we take care about our equity investments. Thank you for joining. Thank you.